Wall Street giants are demanding Washington step in. CME Group and Intercontinental Exchange, the owners of the Chicago Mercantile Exchange and the New York Stock Exchange, are pushing U.S. regulators to bring Hyperliquid under federal oversight. This isn't just a policy complaint. It's a direct challenge to one of crypto's fastest-growing decentralized exchanges, and it could redefine what decentralized really means in practice. The stakes: billions in trading volume, user trust, and the future of U.S. regulatory reach in the DeFi world. CME and ICE have formally urged the Commodity Futures Trading Commission to require Hyperliquid to register as a regulated entity. Their argument centers on market manipulation risks and potential sanctions exposure. If the CFTC agrees, Hyperliquid would need to implement full KYC checks and surveillance systems for trading activity, something it currently avoids by design. This marks a sharp escalation in the growing tension between traditional finance and decentralized platforms. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Hyperliquid has long marketed itself as decentralized, but its architecture reveals centralization points that regulators can target. The network runs on Hyper-EVM, secured by just 31 validators, far fewer than open public chains. More critically, user deposits are funneled through a single custody bridge protected by a 3 of 4 multisig wallet. That means 4 individuals hold the keys, and any 3 can act unilaterally. When billions in trading activity flow through that door, the system looks less like permissionless finance and more like a tightly controlled gate. That structure gives the CFTC a clear path to act, especially if US users are participating despite IP blocks. And they are. The irony hasn't been lost on crypto observers. On-chain investigator ZachXBT pointed out that while NYSE-linked firms are calling for Hyperliquid regulation, other platforms like Polymarket face no such scrutiny, despite similar US access restrictions. Another user highlighted the contradiction. American traders can't legally use Hyperliquid, yet the platform's activity suggests significant US presence. That disconnect strengthens the regulator's argument that geography no longer limits market impact. The platform isn't a niche experiment. It's a $10.8 billion force in derivatives trading, earning substantial fee revenue weekly. But here's where the story gets more complex. At the same time as this regulatory pressure mounts, Hyperliquid is gaining institutional credibility through an unexpected ally, Coinbase. The exchange has become the primary treasury deployer for USDC on Hyperliquid, a move Ansem called extremely bullish. This isn't just symbolic. It could bring Hyperliquid around $150 million in recurring revenue annually and opens doors for broader regulatory navigation and user distribution. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The real test of Hyperliquid regulation isn't just legal, it's structural. The network's design, built by engineers from Harvard, MIT, and Caltech, relies on Hypercore, a high-speed engine processing up to 200,000 transactions per second. It uses an on-chain order book, not automated market makers, to cut slippage. Its native token, HYPE, fuels staking, governance, and fee discounts. But technical innovation doesn't override legal jurisdiction. The Hyperliquid custody concerns remain, especially as long as a small group controls critical functions. So what happens next? The CFTC hasn't ruled. The Hyper Foundation, which manages the protocol, hasn't publicly responded. But the pressure is building. The next signal to watch isn't a price move or a tweet, it's whether the CFTC opens a formal inquiry or demands compliance. The outcome will shape not just Hyperliquid's future, but the broader precedent for decentralized exchange regulation. The regulators aren't just watching. They may be deciding. Hyperliquid regulation is no longer a hypothetical. It's a live conflict between old finance and new architecture. The platform's ability to scale may depend on how it navigates this dual reality, gaining institutional trust while fending off regulatory containment. The custody setup, the validator count, the multisig risk, all are now under scrutiny. And while ETFs and Coinbase provide cover, they don't guarantee immunity. The final word may not come from crypto Twitter or trading volume, but from a federal agency's next move. The question isn't whether Hyperliquid can grow, it's whether it can survive the attention it's now receiving.